Imagine a country faces economic hardship, unemployment is rising, and people are struggling to make ends meet. Wouldn't it be a simple solution for the government to print more money and distribute it to the citizens? After all, more money means more spending, right? While this idea might seem straightforward, the reality is far more complex. Printing more money without a corresponding increase in goods and services can lead to inflation, devalue the currency, and destabilize the economy. In this video, we'll delve into the reasons why printing more money isn't the panacea it appears to be. What is money and where does it come from? Money serves as a medium of exchange, a unit of account, and a store of value. In modern economies, most currencies are fiat money, meaning they have value because the government declares them legal tender, not because they're backed by physical commodities like gold or silver. Central banks, such as the Federal Reserve in the US or the State Bank of Pakistan, are responsible for issuing currency and managing the money supply. They use various tools, including setting interest rates and open market operations, to control inflation and ensure economic stability. What happens when you print too much money? When a country prints more money without increasing the number of goods and services being produced, there's suddenly more cash chasing the same amount of things. This causes prices to rise because sellers know people have more money and are willing to pay more. It's basic supply and demand. Too much money and not enough products means the value of money drops. So even though people have more money in their hands, they can actually buy less. This also creates a vicious cycle. As prices go up, people want more money to maintain their lifestyle. The government might respond by printing even more money, which only makes the problem worse. The hidden danger: inflation versus hyperinflation. Inflation is something most of us experience all the time. A little inflation, say 2% a year, is normal and even healthy. It means the economy is growing. Wages go up, businesses expand, and people continue to spend. Central banks carefully monitor inflation to make sure it stays under control and doesn't hurt the average citizen's spending power too much. But when inflation gets out of hand, it turns into hyperinflation, and that's when things become dangerous. Prices rise so quickly that money becomes useless in a matter of days. Imagine needing twice as much money just to buy bread as you did yesterday. Case study: Germany after World War I. After World War I, Germany was under extreme pressure to pay reparations to other countries. It didn't have enough gold or foreign currency, so the government started printing German marks to cover the costs. At first, this seemed to work. Debts were paid and money flowed. But soon, the amount of printed money far exceeded the value of goods in the economy. By 1923, the German mark had become practically worthless. Prices were doubling every few days. People carried bags of money just to buy bread. Some even used currency as wallpaper because it was cheaper than buying real paper. This destroyed savings and trust in the economy. Can't governments just control prices? In theory, governments could try to stop inflation by forcing companies to keep prices low. But in practice, this often backfires. If businesses are told to sell items at a loss, they might stop producing them altogether. This leads to shortages, empty store shelves, long lines, and black markets where people pay even more to get what they need. Price controls can work temporarily, but they don't solve the real issue: too much money and not enough goods. Instead of encouraging production, they often push companies out of business. Over time, the economy becomes even more fragile. But what about the US or Japan? Don't they print money? Yes. Countries like the United States and Japan do print money, but they do it in a very controlled and strategic way. This process is often called quantitative easing, and it's managed by their central banks, not their governments directly. When these central banks create money, it usually goes into the financial system, like buying government bonds, to encourage lending and investment during slow economic times. The difference is that these countries have stable, trusted economies and strong institutions that make their currencies reliable. Investors and citizens still trust the dollar or yen even if new money is added because they believe the central banks will keep inflation in check. Who actually controls the money supply? The money supply is not directly controlled by the government. Instead, it's regulated by a country's central bank, for example, the Federal Reserve in the US or the Reserve Bank of India. These institutions are responsible for managing interest rates, controlling inflation, and ensuring financial stability. They don't just randomly print money, they adjust the supply based on what's happening in the economy. Central banks use different tools, like changing interest rates or buying and selling government bonds, to influence how much money is circulating. Their main goal is to keep inflation in check while supporting economic growth. This balancing act is delicate. If they pump in too much money, prices can rise too fast. If they cut too much, the economy can slow down. So, while printing money sounds simple, in reality, it's a highly technical process that requires careful planning and a long-term vision. Why printing money doesn't solve poverty? At first glance, it might seem like printing more money could help reduce poverty. Just give everyone more cash, right? Unfortunately, that's not how it works. If everyone gets more money but there aren't more goods and services to go around, all that happens is prices go up. In the end, people are stuck paying more for the same things, and those who were already poor end up struggling even more. Real poverty reduction comes from improving access to education, healthcare, jobs, and infrastructure, things that help people earn more and live better lives. Simply handing out cash by printing money doesn't fix the underlying problems. In fact, it can make inequality worse, because the wealthy are often better protected from inflation than the poor. The key to fighting poverty is creating long-term economic opportunities, not short-term handouts. What happens to your savings and salary if money loses value? Inflation erodes the real value of money. If your salary doesn't keep up with rising prices, your purchasing power declines. Similarly, savings lose value over time if the interest earned is less than the inflation rate. This can discourage saving and long-term financial planning, leading to reduced investment and economic growth. Under the gold standard, currencies were backed by a fixed amount of gold, limiting the ability of governments to print money. While this system provided stability, it also constrained economic growth and limited the ability to respond to financial crises. Most countries abandoned the gold standard in the 20th century in favor of fiat currencies, which offer more flexibility in monetary policy. Can cryptocurrency or digital currencies solve this? Cryptocurrencies like Bitcoin have a fixed supply, making them resistant to inflation caused by excessive money printing. However, their volatility and limited acceptance as a medium of exchange pose challenges. Central bank digital currencies, CBDCs, are being explored as a way to combine the benefits of digital currencies with the stability of traditional monetary systems. What should countries do instead of printing more? Instead of printing money, governments should focus on policies that promote economic growth, such as investing in infrastructure, education, and innovation. Structural reforms, fiscal discipline, and efficient tax systems can also help address budget deficits without resorting to inflationary measures. The value of money is fundamentally based on trust. If people lose confidence in a currency's stability, it can lead to reduced usage, capital flight, and economic instability. Maintaining this trust requires prudent monetary and fiscal policies, transparency, and effective governance. What we can learn from history and avoid repeating. Historical episodes of hyperinflation, such as in Germany and Zimbabwe, highlight the dangers of irresponsible monetary policies. These cases underscore the importance of central bank independence, fiscal discipline, and the need for comprehensive economic planning. While printing money might seem like an easy fix for economic problems, it often leads to unintended consequences like inflation, currency devaluation, and economic instability. Sustainable economic growth requires thoughtful policies, investment in human capital, and maintaining public trust in financial institutions. Now that you understand why printing more money isn't the magic fix it might seem, it's time to look at money and the economy with wiser eyes. Share this video with someone who thinks printing cash can solve poverty or boost the economy overnight. Let's spread awareness and break the myths. And if you found this helpful, don't forget to like, subscribe, and hit the bell icon, because we've got more clear, easy-to-understand explainers coming your way. Together, let's build a smarter, more informed world, one truth at a time.